Thursday, January 27th to order. We have a pretty full agenda today, so a couple of housekeeping things to start with. Senator Dietrich, do you have some guests with us today?
Thank you, Mr. Chair. I do. I have 3 students from J. Scheidler Elementary here in Topeka, and they're paging with me today. You want to wave, boys? Welcome.
Good morning and welcome to the committee. Let's turn to bill introductions. Kelly, KBA.
Good morning. Thank you, Mr. Chairman, members of the committee. I have one bill to introduce, 22 RS 2828. It is a bill to modernize the Kansas Trust Code.
Thank you, Kelly. Committee, are there any questions? You're letting her off way too easy. Is there any objection? Your bill will be introduced.
Thank you.
Senator Holscher, do you have a bill introduction?
Thank you, Mr. Chair. I have RS number 2464, which is relating to healthcare insurance provider availability for maternity centers.
Okay, any questions? Any objection? Seeing none, that will be introduced. Do you have another one?
No, I was going to ask.
Okay. Any additional bill introductions that I'm not aware of? Okay, we will now turn our attention to open the hearing on Senate Bill 377. David, would you give us an overview?
Thank you, Mr. Chairman. Good morning. Senate Bill 377 is a bill that would authorize the creation of technology-enabled fiduciary financial institution, or TEFI, insurance companies. And this would be within the current Captive Insurance Act, which is found at KSA 40-4301 at SEEK. Just kind of a reminder, a captive insurance company insures the risks of a parent company or any affiliated company. So it would be kind of a subsidiary of that parent and insure the risks for those parent or affiliated companies. The bill would add a new section to the Captive Insurance Act, and this is Section 1 of the bill, that would establish the TEFI insurance companies. As part of that section, it's the requirements for the operations and the certificate of authority that would be issued by the Commissioner of Insurance. Including authorizing TEFI insurance companies to provide contracts of suretyship or credit insurance when the obligee is or insured is an affiliated TEFI or fiduciary financial institution, an affiliated FIDFIN trust, or any other affiliated company. This also provides for the types of risks for which a TEFI insurance company may insure against. That's in subsection B of Section 1. It lists the events that would constitute fortuitous events for the purpose of any policy or product offered by the TEFI insurance company. It exempts the TEFI insurance company from the requirement to use the word captive in such insurance company's name if the TEFI company uses in its name any of the following. They'd have to use technology-enabled fiduciary financial institution insurance company, or they can use TEFI insurance company. They can use Kansas e-commerce FIDFIN insurance company, or they can use KEFI. The bill also allows a TEFI insurance company to have its principal place of business in the same or shared office premises with the affiliated TEFI or another TEFI insurance company, so they can share that office space. Allows any person to serve on the board of the affiliated TEFI or other affiliated company to also serve on the board of the TEFI insurance company, and provides that that person could fulfill the residency requirements for both the Captive Insurance Act and the Technology-Enabled Fiduciary Financial Institutions Act. So the same person could fulfill the Kansas residency requirements for those companies. It allows the TEFI company to enter into service contracts with other TEFI insurance companies, affiliated TEFIs, or affiliated companies. Provides requirements and procedures when a TEFI company would issue a payment in kind policy, and that payment in kind policy is defined in the bill. That's actually in Section 2 of the bill. We'll get to that in a second. Allows insurance Any insurance company, regardless of jurisdiction, that's permitted to hold equity interest in an affiliated TEFI to utilize such equity interest as in-kind assets when issuing the payment in-kind policies, and does not require any more than one employee in Kansas to provide services for the TEFI company or to facilitate the examinations that would be required under the Captive Insurance Act by the Department of Insurance. Considers a TEFI insurance company to be an insurance company for the purposes of the insurance statutes, and to have its primary and predominant business activity the writing of insurance or reinsuring of risk underwritten by insurance companies, and specifically states that it will be subject to the supervision of the commissioner. Allows policy provisions within that the policies would be governed by and construed in accordance with Kansas law, and allows policies to also have a forum selection provision requiring that any suit or action be brought either in a Kansas District, State District Court, or would have to be brought in the U.S. District Court in the District of Kansas, and that such provisions would be fully enforceable. Provides that a payment in kind policy issued to a qualified policyholder shall be fully enforceable in accordance with the policy's terms and conditions, and then just has a general section at the very end of Section 1 how this should all be construed in any proceeding. Section 2 actually goes in and starts amending the current captive insurance statutes, KSA 40-4301. That's a definition section. It adds various TEFI-related and FIDFIN type definitions throughout that section, and then also provides a definition for what an in-kind asset is, a payment in-kind policy, and then also defines what a qualified policyholder would be, and that would be a qualified policyholder would be an affiliate FIDFIN trust, the owner or deemed owner of an affiliate FIDFIN trust, if they have a certificate of ownership, or a qualified purchaser as defined under the Federal Investment Company Act of 1940, or it could be an institutional investor as defined in the Kansas Uniform Securities Act. Section 3 would actually amend KSA 40-4302 to permit a TEFI insurance company to provide contracts of suretyship and credit insurance. This provides us an exception to the general prohibition within the current Captive Insurance Act that captive insurance companies cannot provide surety services. This would specifically allow the TEFI company to do so. There's also amendments in this section to change the certificate of authority renewal date for the TEFI insurance company. It would be either the later of March 1 or the maturity date of the last payment in kind asset held by the TEFI insurance company. And the section further amends this statute to protect the privacy of qualified policyholders and those who have established affiliated FIDFIN trust or alternative asset custody account in any court proceedings. Section 4 amends KSA 40-4303. This kind of refers back to the naming requirements. Under current law, each captive insurance company is required to use the word captive somewhere in their name. This would say that for a TEFI insurance company, as long as they comply with those naming requirements I mentioned in Section 1, they would not actually have to use the word captive in their name. Section 5 amends KSA 40-4310 to allow the TEFI insurance companies to hold in-kind assets, and such in-kind assets shall be considered a part of the reserves, capital, and surplus of the TEFI insurance company, and it also allows the company to hold equity interest in an affiliated fiduciary financial institution. And Section 1 is just a conforming amendment to make sure that Section 1 becomes part of and supplemental to the Captive Insurance Act, and the effective date would be upon publication in the Register of Senate Bill 377. And I can stand for any questions, Mr. Chairman.
David, thank you. Committee, are there questions? Senator Pittman.
Thank you, David. On page 14, we start talking about the privacy of the policyholders. Is that a pretty common thing to have in these types of things, to have the privacy of the policyholders be explicitly kind of protected like it is there and in page 15, section D? I'm just curious about that.
I don't know if I could speak to how common it would be. I do believe a similar provision was in the TEFI Act itself last year, but I don't know on these particular ones if it's common. I think can
Side
speak
of
to that.
insurance kind of law, whether these types of things are common or not. You don't know?
I don't know.
Thanks.
Committee, additional questions? David, I have one. As I understand it, this bill is very narrowly tailored to TEFI captives only and does not affect non-TEFI captives that we already have established. Is that accurate?
Yeah, that's correct, yes. This is specifically the TEFI insurance companies and then their procedures.
Any additional questions? Senator Hildebrand?
Thank you, Mr. Chairman. Not a question, just probably more of a comment to Senator Pittman's question. Privacy is an issue that all insurance companies have with their policyholders. So
By statute.
I'm not sure if it's in statute. I think it probably is in there because there is a privacy policy that each policyholder receives. So.
Okay. Any additional? All right. Thank you, David. We will now turn to proponent testimony. We have Derek Fletcher, President and CFO of the Beneficient Company Group. Derek, welcome to the committee.
Great. Thank you, Chairman Longbine and members of the committee. Thank you for allowing me the opportunity to testify in support of Senate Bill 377. David did a great job of summarizing it. What I'd like to do today, with your permission, is to just briefly provide a summary of the TEFI business. And again, I know each of you is familiar with that. I do want to reassure you that this is not an adjustment to the TEFI legislation, but really kind of complementary legislation, and I can explain the reasons for that during my testimony today. But as you will recall, a TEFI is a specialized trust company that is regulated by the Office of State Bank Commissioner. And the pilot program TEFI, Beneficient Fiduciary Financial, received its authority to transact business, as you know, on December 31st. So the TEFI provides specialized trust administration services, financing, and custodial services to owners of alternative assets. And what I'd like to do is just refresh your memory on what is an alternative asset and what an alternative asset is not, because it does relate to the insurance coverages that we will be talking about this morning. So on slide, I believe, 3, is kind of a list of alternative assets. And as you will recall, an alternative asset is an investment that is not publicly traded, that is managed by a professional investment advisor who is registered with the Securities and Exchange Commission. The investors in these assets can really be broken down into 3 categories. Number 1, large institutional investors, like CAPERS, so large pension plans that have a significant allocation to this type of investment. The second are small to medium-sized institutions, so think of your hospital foundations, your firemen and police pension funds that will be invested in these types of assets. And then the third category is high net worth individuals. These are individuals with net worths or investable assets of $5 million at a minimum and up, excluding their homes and their businesses. And so sophisticated investors in all 3 of those categories. What an alternative asset is not, which is on the next slide, it is not cryptocurrency. It is not foreign currencies. It's not artwork, gold bullion, Kansas farms. It's not when a group of doctors, for example, buy clinics and they put them in a special purpose entity and they hire a property manager. It's none of those types of assets. These are investments that are managed professionally by advisors registered with the Securities and Exchange Commission. So under the TEFI Act, these types of assets will be placed into Kansas trusts or into Kansas custodial accounts, with a TEFI serving as either trustee or as the qualified custodian of those assets. And as you can appreciate, in serving in a fiduciary capacity and executing these various duties and obligations on the part of our customers, the TEFI is looking at, just like any trustee would, how do we protect the trust estate? How do we protect the trust estate for the benefit of our beneficiaries? And a common method for doing so is certainly procuring insurance to guard against certain risks that are attendant to those types of assets. And so just at a very simple level, is you can appreciate a trust company such as ourselves will have a commercial fidelity policy, right, that will guard against, any fraud within the company or malfeasance that might occur. But those commercial policies don't really cover all of the risks associated with these alternative assets, and that's what we're going to talk about this morning. David did a great job of really kind of laying out the structure of the statute. And so just to give you a sense of the types of risks that the TEFI would be looking to provide kind of risk management over, and this is delineated on slide 5 as you see here. First, as an example, we have a customer that comes to us, and I'll say us broadly because this is not a beneficent bill, this is again for the TEFI industry. So comes to a TEFI and they're looking to secure financing. They provide as a part of that process representations and warranties that I, the investor, I own this asset and I have the right and the power to transfer that asset into this trust as a part of the financing transaction. And so that financing will occur. There's certainly due diligence that's performed at the TEFI level. There is financing extended, the customer walks away. And then as a part of effectuating and finalizing the transfer of that asset with this professional manager, it could be determined that, the customer did not own that asset or the entirety of the asset that they represented, or they did not have the ability to transfer that asset into the trust, in which case that transfer may not be respected by the manager, which could create economic damage to the trust. And so it would be coverage that it's not title insurance, but you can kind of think of it as kind of a title insurance overlay that protects the trust in terms of the ownership of that asset. These are professionally managed, and again, with investment advisors that are registered with the SEC, but that does not mean that they could not encounter negligence on the management of those assets, have lawsuits attendant to the underlying assets that they are managing. You could even certainly have managers that engage in some type of fraudulent transaction, each of which, again, could adversely affect the economics of the underlying alternative asset. Credit risk, again, financing these assets, and so to protect kind of protection of the financing and ability to repay. And then finally, again, as I mentioned, with trust companies, you certainly want to protect your trust beneficiary in terms of your own management of the underlying asset. And so in addition to commercial fidelity insurance, which has gaps in it, this legislation would enable protection against, kind of really indemnity, surety, fidelity type of coverage associated with the alternative asset. So to talk about kind of why are we here, to talk about captive insurance, as David explained, a captive insurance company is one that insures its parents or a group of affiliates. Once established, it operates like a commercial insurance company from the standpoint that it writes policies, it collects premiums, it pays claims, subject to oversight by the Kansas Insurance Department, although the regulatory oversight differs somewhat since it's not a commercial insurer to the general public, but it is subject to that oversight. So one of the things that, and I'm sure this committee is aware of, the NAIC has indicated there's over 7,000 captives globally, with Bermuda and the Caymans being the leading jurisdiction for those types of insurance companies. There are certainly domestic captives, with Vermont leading the charge. They've got about 600 captives. Utah at second place, 400. Delaware, 300. And then as you work down the list, my home state, Texas, about 60. And Kansas and West Virginia have one captive each. In 2018, the legislature here in Kansas modernized the captive insurance laws. And really the purpose, at least based on testimony that accompanied that legislation, was the purpose was to try to generate captive business within the state of Kansas and to prevent existing Kansas companies from migrating to other jurisdictions, whether that is domestic or international. So our company, Beneficient, as well as many of those in our industry, we have a captive insurance located in Bermuda that we've been working with the Bermudan Monetary Authority in terms of all the coverages that I have mentioned today. About the time that the TEFI legislation was being introduced last year, we became aware through our advisors that there were tax law changes that affected insurance companies such as the one that we would have domiciled in Bermuda that really eroded a lot of the tax deferral benefits that could be achieved in having that offshore captive insurance company. And so if you think about the management of that type of entity offshore, the tax benefits are important because that offsets your operational cost of making sure you have staffing offshore. When you bind a policy, an insurance policy, we would have to send an executive to Bermuda to bind that policy. And so there's a lot of inefficiencies from an operational standpoint. And so we were evaluating, given the diminution in the tax benefit with the operating costs, maybe we ought to think about domesticating our captive. And that's when our advisors had indicated, you know, you really should look at Kansas because Kansas has a captive insurance act that gets you really 95% or 85% of the way there. There's some adjustments that will be needed to align with the unique nature of a TEFI's business, and it would allow the state of Kansas really to have a complete control of a TEFI's operation and oversight and really bring the entirety of the industry here into Kansas, which we think will be beneficial from an economic perspective in terms of additional capital coming into these insurance companies and the premium taxes associated with the placement of insurance. So with that, we can talk about kind of the scope of the legislation. And again, David covered much of this, so I'll be brief. But because we deal in the TEFI industry with specialized assets, there's a need for kind of specialized coverages. And so the legislation discusses the description and types of insurance that a TEFI insurance company could provide. It identifies the events that would give rise to claims on those policies. It talks about the relationship between a TEFI and a TEFI insurance company and the overlap in terms of maintaining a place of business, having common employees, common directors within the state of Kansas, and shared services agreements between the two entities. And something that I'll spend a little bit of time on is it has a feature, as David mentioned, of payment in kind. And so let me just kind of give you a sense of that payment in kind and try to do so briefly. Up on the slide that you have in front of you, you'll see kind of the typical return profile of an alternative asset. And that is the dotted line that looks like a J. It's referred to as a J curve. So at the beginning, on the left-hand side of that line, that is when an investor makes a cash investment into the alternative asset. And you'll see for the first few years, what happens is you actually experience from an investment perspective a loss. And why is that? That's because there's fees and expenses as the investment manager is acquiring companies, as they are building those companies up and improving the operations of those companies, turning them around, getting ready to take them public, whatever the strategy might be. And then so about the third year or so, you start to see what's called the harvest period. The investment starts to produce a return, and then you experience a positive return profile through the end of that investment's life, which is contractually stated in the partnership agreement. So if you think about, if I, as a TEFI managing a trust that owns an alternative asset, I have financed that asset in almost every instance after that deployment period has occurred and as that asset is in the harvesting phase. So stated differently, as there's starting to be a positive return on those assets. So if I receive a cash payment on a claim, so I've experienced a loss and I receive a cash payment, that certainly is helpful. It helps me recover that loss, but it puts me at the very beginning of that investment period when at the time of my loss, I had this return that I was expecting throughout the life of the asset. So I'm back at the very start where I would have to reinvest that asset, experience that decline, and enter my return phase. What I would like to do is I would like to receive, instead of that cash payment, I'd like to receive an asset that's on the same point of that return profile, right? So that my expected return on the asset remains constant with what that return profile looked when the asset was placed in that trust. That places the trust and the trust beneficiaries in as close a same position as they would have been if there would not have been a loss that had been incurred. That is the reason for the payment in kind feature on this policy. And what it means is that the insurance company, the captive, would be able to hold alternative assets as a part of its reserves and capitalization. There would be a contract, an insurance contract, that would specifically state, when the trust binds that contract, these are the assets held by the insurance company that can be used to replace that loss, to enable the trust to recover that loss in the event a fortuitous event occurred, with the agreement being that that is a close approximation, if not an identical asset, again, that would allow the trust to recover. That would all be spelled out upfront in the policy. So it's not discretionary on the part of the insurance company to kind of pick and choose later. It's what the trust and the insurance company agree to at the outset of that policy. And so we believe that the statutory framework that you'll see within the legislation, again, is a kind of a scalpel approach in terms of how do we provide for the unique insurable needs of a TEFI without disrupting the captive insurance bill overall. And again, our belief is from an industry perspective, because we have a captive, we see the value in a captive insurance company as a part of our business. As other TEFIs come into the state of Kansas, they too, in addition to forming that TEFI, would choose to form a captive or port their captive into Kansas so that those two can coincide together, operate efficiently, share employees and their principal office, and achieve some operational efficiencies as a result of doing so. So with that, Mr. Chairman, I'll pause and certainly willing to answer any questions that the committee might have.
Derek, thank you very much. Captive insurance companies are something that we don't often deal with, so I want to make sure that the committee's got an understanding.
Absolutely. And Mr. Chairman, if I apologize if I might, I will say that we have had a good number of meetings, I believe 4 meetings with Commissioner Schmidt and her team at the insurance department. We have a call with them again tomorrow, so we're collaborating with them in terms of this legislation. They've been very open in terms of that dialogue, and certainly have an interest in seeing an expansion of the captive industry in general. Certainly can't speak for them in terms of this particular legislation, other than to say we're having very good dialogue with them about this legislation and sharing thoughts with respect to it.
Okay. Derek, I want to make sure we have a good understanding of a captive. So as I understand it, there are fees or profit expectations within a TEFI when a contractual obligation is established with a customer. And so there are either fees or profits associated with that transaction that the TEFI would then decide to take a portion of that and put into a captive insurance company to guarantee themselves against any loss. And then that captive insurance would acquire reinsurance behind it to minimize their potential losses.
That's correct.
So it is simply a captive insurance company self-insuring against some losses, either through fees or profits, is what would seed that captive insurance company. And then there's reinsurance behind it in case of a major loss or too many losses or whatever, that reinsurance behind it. Is that?
Mr. Chairman, that is correct. And there is a slide that I did not cover which shows that reinsurance, which I believe is the next slide. But you're exactly right, that the TEFI would have the insurable need, it would seed the captive. There would be a risk of loss that the captive is willing to take and effectively self-insure. And then you're exactly right that captive would then reinsure within the reinsurance market. And the Captive Act has provisions in terms of those reinsurers and the qualifications that must be met in order to be a qualified reinsurance company under the existing Kansas statute, which is not being adjusted with the ability, certainly of the Commissioner's office to oversee kind of that reinsurance process. But that is exactly right.
Okay. Committee, are there questions? Senator Gossage?
Mr. Chair, thank you for that clarification because that answered actually two of my questions, so I appreciate that. So what we're doing here today, or what you're asking, is that the Kansas Captive Insurance Act have some amendments to that or some changes to that specific to the provisions that would allow the TEFI to do this.
Yes, ma'am.
So you can work within that framework, but there are some specific adjustments that need to be made, and that would be within SB 377.
Yes, Senator, that's correct.
Okay.
That there the types of coverages that are really attendant to these assets that are not really addressed in the existing captive statute, and then the payment in kind feature are really the two predominant changes. And then, as David mentioned, there's certainly the enforceability provisions. There's the definitional provisions that need to be incorporated in order to make sure that that dovetails into the existing Kansas legislation.
And my final question, Mr. Chair, is that the Kansas Captive Insurance Act, by the nature of that act, says that the insurance department would regulate this. Is that correct?
That's correct, Senator.
Thank you.
Committee, are there additional questions? Senator Pittman?
Thank you, Mr. Chair. Yeah, love to sit down with you just a little bit to go through it one more time. It seems like, to Senator Gossage's point, we already have the captive insurance program.
Yes, sir.
And I guess the benefits of that to companies like yours is there might not be similar instruments in the mutual insurance market, commercial market. So you go in and you absorb the risks, or the company like you're talking about would absorb risks through its pieces, and they are going to do that for certain benefits, right? And Kansas acknowledged that we like this. We like to enable this for those that want to take on that risk, right?
That's correct, Senator. Yes.
And we have these established laws. We need to make some changes. To put, I guess you're saying it wouldn't necessarily, it doesn't specify TEFIs now. So we want to include that as a possibility. I think that's right. And then the second thing is these in-kind pieces. That seems to be a pretty important piece of this.
You're correct. Yes, sir.
And that's what I want to kind of get to is understanding. I know there's cash flow benefits and things like that we gain just to get an understanding so I can have a working knowledge so I feel more comfortable with it. Are we tying certain assets to certain in-kind payments, but we're not saying to certain holders? Are we kind of isolating some of these investments for certain trust funds into certain accounts and then making sure that the insurance company, captive insurance company, is not liable or required to somehow merge or pool those assets in some fashion or form? Or could you just kind of lay that out and what that specific requirement is, just in a nutshell?
You bet. So the legislation really addresses two different fact patterns, one in which the insurance policy requires in-kind payment, and then the obligations on the part of the captive insurance company to maintain those assets to satisfy any claims against the policy. And the second is when it's not required, but it's permissible for the captive to fund any claim with in-kind assets. In each of those situations, there's always the backstop that if there was a loss without the in-kind assets, or the in-kind assets were insufficient to fully satisfy that claim, it would be cash pay. So there's always a cash pay as a backstop in terms of that loss. But there would be, to your point, on a schedule on the insurance policy that would identify specific assets that would be held by the insurance company. And that would be existing assets held at the insurance company that would be used to satisfy. And it's really, Senator, a way to make sure that, again, the goal to place that trust on the same part of that return profile. So it's identifying assets that are equivalent, that the policyholder as well as the insurance company agree to up front, rather than kind of a discretionary basis on the part of the insurance company later to select assets. And so it would be identified assets that the company would hold, insurance company would hold as a part of its reserves that would be identified to cover those particular policies where those assets have been identified.
So So if a normal captive insurance would typically just pay out cash.
Yes, sir.
Is the idea, right?
That's correct.
Take an in-kind asset, something that's of a similar profile in terms of its return risk as well?
Yes, sir. So it would be
All those dimensions?
all those dimensions in terms of the geography, the industry, the age of the investment, all of those attributes that we've discussed as a part of the TEFI in terms of the financing that you consider would also be considered in terms of, are those kind of effectively like-kind assets that are appropriate in terms of that payment in kind policy.
Senator Dietrich was a trust that was inside of there. She has a certain profile going along those different dimensions. Something happens where the bottom drops out of part of that. The insurance company is now allowed to say, we've got a similar profile along all these different dimensions. We're going to take that and put that into your trust as a in-kind payment.
Correct.
So that you're held whole.
Correct.
And does anybody else lose out when that happens, or that's the risk to the actual insurance company?
It's a risk to the insurance company, and the reason they're holding those assets for that payment in kind. And again, as the chairman mentioned, behind that would be reinsurance. With that reinsurance, that could be structured either, again, as a cash pay reinsurance or an in-kind reinsurance that would then, accept a portion of that risk from the captive onto those reinsurance companies' balance sheets.
And then the last question, Mr. Chair. There's a series of things about the chain of, we're limiting, I think, the policyholder maybe about how much information they really need to have about this in-kind piece of it. Like, they don't really need to know all the different aspects of what that other in-kind investment is that correct?
No, they would have full transparency on that. The privacy items, if that's what you're referring to.
The privacy thing has to do
Okay.
with lawsuits and
Yes, sir.
revealing names. I saw inside of the series of different conditions, there's a couple things about the chain of, that do they get a choice? In other words, that we have a series of assets that have been transferred from one to the other in some example or something. Is this saying that they don't really need to know what that is and that they have to kind of take what you give them, or is there some kind of a transparency to the assets that are being paid in kind?
There would be that transparency because it would be, those assets would be identified on a schedule to the insurance policy itself. And so when that policy is bound, you would already have identified these are the in-kind assets that would be available and used to pay on any claim. So the policyholder would have that information as a part of the policy contract.
Okay, thank you, Mr. Chair.
Derek, along those lines, I'm under the assumption that the insurance department, as your regulator, will view those assets and those transactions on an examination basis at some point. And so there is that separate eyes of those transactions. Correct. And then I also would be under the assumption that your reinsurance premiums would be based on loss ratio and how well you are managing that captive insurance company. And so mismanagement of that would certainly drive those reinsurance premiums up and make it possibly unaffordable if things were not being done correctly. Is that fair?
Yes, Mr. Chairman, that is correct.
Committee, are there additional questions? I see none. Derek, thank you. I will tell the committee that I do know that Beneficient has had multiple meetings with the insurance commissioner. I have had 2 meetings with the insurance commissioner on this this bill. I can't speak for the insurance commissioner, but I do believe in my mind that there is a level of comfort there. I don't have any neutral or opposition testimony from the commissioner, so at this point I have to assume that the department is okay with this. So. Is there any additional proponent testimony? Any neutral testimony? Any opposition testimony? Seeing none, we will close the hearing on Senate Bill 377. Committee, we will not meet tomorrow. We will not meet on Monday. We have a pretty full agenda for next week on Tuesday and Wednesday. Thursday, it would be my hope that we can kind of clean up some of these bills that we've heard and work those bills that we've heard this week and the first part of next week, and hopefully kick some of those out and get them headed to the floor and through the process. So, any other business that we need to cover? Any questions? Okay, we're adjourned.